And good morning, everyone, and welcome to this morning's Coffee Microcaps Appendix 4C results wrap. You're very welcome back. I'm delighted to say that we've got 4 companies presenting with us here this morning. My name is Mark Tobin. I'm the founder of Coffee Microcaps. For anybody who's joining us for the first time, I'm just going to quickly run through these intro slides and then we're going to get straight into it. Firstly, I'd like to give a shout out to DMX Asset Management, our virtual event sponsor here at Coffee Microcaps. If you are interested in a smaller microcap fund manager, please get in contact with Stephen or Michael or indeed check out their website. Quick compliance and disclaimer slide. For anybody who's joining us for the first time, the companies we normally have presenting on here are capped under 300 million in revenue and approaching cash flow break even, or indeed already profitable. We generally don't have companies from the resources or biotech sectors, what I call industrial microcaps, which encompasses basically all the other sectors: microcap technology, healthcare, financial services, retail, anything kind of outside of resources or biotech. Structured this morning's webinar. We've got 4 companies presenting. Setup of this morning's webinar, each company's got 30 minutes, which we're going to break down into a 20-minute preso and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions to our presenters. And please note the webinar is being recorded and it'll be posted on the Coffee Microcaps YouTube channel tomorrow morning. You can follow us pretty much on all the socials: Twitter, LinkedIn, YouTube for the recording of this webinar, and indeed all the other webinars. We've got over 100 ASX microcap presentations on the channel now, and I also write a free monthly newsletter that you can grab on the Substack platform. Up first, we're going to be going to Martin Filz, CEO of Pureprofile. Delighted to be welcoming Martin back. After that, then we've got a first-time presenter, Paul Ostergaard from Norwood Systems. Then we're going over to the States for our last 2 presenters. Wayne Arthurs from Skyfii coming back to give us an update. He's going to be joining us from San Francisco. And indeed, Oleg Vornik from Droneshield is going to be joining us from the other coast over in Boston, also coming back to give us an update. So without further ado, I'm going to stop sharing my screen, and Martin, I'll let you know when I can see your slides coming through. Yeah, they're coming now. And yeah, if you just want to go to full screen, but yeah, perfect. Okay, you're good to go, mate.
All right, fantastic. Thank you, Mark, for the introduction. Thanks for having us back. Hello to everybody for dialing into the call. I'm going to give you a quick overview of Pureprofile and the unaudited H1 numbers and Q2, as we just completed. Disclaimer, as Mark had up. For those of you who don't know Pureprofile, we're a data company. At the heart of everything we do is data. It powers the insights we generate for market research projects, people coming to us. Perhaps it's as simple as surveying people, 2 million people around the world, to understand their affinity to brands, etc. Or launching campaigns. We have a media arm that launches campaigns all in first-party data. And then we have some SaaS technology which underpins what we do. So data is at the heart of what we do. And then in the pink circle, market research makes up about 90% of our revenue. So that's 2 million people around the world, highly engaged consumers, and so that brands, governments, education, etc., can understand their audience better. And then on the right-hand side, we use that data again for launching more accurate, better campaigns for, again, a wide range of brands and advertising agencies we work for. So that's what we do. Why do they work with us? Well, firstly, millions of people around the world. We're a 24-year-old company, so we're very trusted in the field of what we do, and that's really important to brands that might be running a small project of $50,000 or $100,000, but they want to work with, but they're making decisions on the back of that that's worth multi-million-dollar decisions, and therefore they want to work with brands they can trust, etc. And then people come back to us because of our service, so being fast, being absolutely personal, dedicated teams, and high quality. What do we do? As I said, we do data and insights, helping people understand their audience better, their consumers, their customers, their competitors' customers. Makes up about 90% of our revenue. Pure Amplify Media, that is launching campaigns for brands, makes up about 10% of our revenue. And then within that 90 and 10%, we have self-service platforms, 3 main products. Insights Builder, companies can launch campaigns on their own. Audience Builder, we hook into big loyalty schemes like Flybuys. There's a customer here gathering data, enabling their members to earn rewards, etc., through doing surveys. And then we have Audience Intelligence, gather data on over 400,000 Australians, and that daily transactional data, looking at real-time bank account expenditure, credit card expenditure, again helping brands like Uber Eats, like Coles, etc., understand their audience and what their audience is doing. And then what do? We help businesses grow. So as we said, globally, we did research from 94 countries in the last 12 months. So that's helping people understand and leveraging all of that proprietary data and then those self-service products. Majority of our revenue today, 60% or so, comes from Australia. That's quickly changing. Why is that quickly changing? Well, the UK market, where we've been since 2006, is actually 14 times bigger than the Australian market, and the US market is 40 times bigger than the Australian market. And still in both markets, we're relatively small. We do about $16 million or so out of the UK market, where we've got about 15 people. And in the US, we'll only do about $3.5–4 million this year. So big opportunities, and that's where we're seeing our particular growth and where we're doing our investment at the moment. So moving on, what's our key strategy? So the key strategy is number one, being global. When I joined the company as CEO 2.5 years ago, we're in 5 countries. We're in 9 countries today. And as that previous slide showed, that's the real opportunity. So doing what we do in Australia, do what we do really well, do that globally. Improving our technology, so that's giving client-facing solutions, efficiencies internally as well. And then finally, focusing on that data and insights and that media adverts business. So being really, really laser focused to what we do as a business and what clients want us to do. We have a 3-stage strategy. So as I said, when I joined 2.5 years ago, it was about doing a company restructure and recapitalization, strengthening the balance sheet, bringing key people from around the world that I've worked with before to really, as I said, laser focus this business. So we did that. We are now in stage 2, and we're coming towards the end of stage 2. So that's replicating our successful business in new markets outside of Australia. To give you an idea of how successful we are, over 20% of the ASX 200 works with us as a business. And so that gives us a fantastic platform to grow from. Focus, growing that global panel expansion and that data points that we have around the world, improving our efficiency and our profitability. One of the key focuses with my partner, our COO, Shepherd, is that we've been cash flow positive for around 2 years now. And that's been a real key focus of the business, to make sure we're cash flow positive, to make sure we're investing within our means. We're still growing the business, but we're actually doing that in a way that is sustainable and is a real good return for our shareholders. Continue our core technology, implementing our new technology solutions, and then that's about having the right culture, and we have an amazing team of people that we work with. We then are moving to stage 3 in our financial year 24, so not far away now, and that's more client-facing solutions, improving that efficiency that we've got internally to keep growing that EBITDA percentage that we have been growing over the years, and to ensure that we really are a truly global business. We're in 9 offices around the world, 784 clients, 202 staff, repeat business, 39.8 million in revenue from repeat clients, really important metrics. We have really high NPS score from our clients, so once clients start to use us, they keep using us. And then growing that SaaS, that annuity revenue, and it's now 9 million in the last half, up from 7.4 million previous year, so growing that SaaS revenue. Financial highlights, we in Q2, it was another record quarterly revenue for us, so that was 12.8 million revenue, up 21% across our data and insights to SaaS business. EBITDA was 1.2 million, that's 9% EBITDA margin, up from 8% in Q1, which is some guidance that we've given. And our growth in regions outside of Australia are up 43%. So that's a revenue up 21%. EBITDA was down 12%, but up to 9% margin. And I'm sure we'll talk to Mark at the end about why we had expected that, an additional investment that we made in Q4. Data and insights, where did we see that growth come from? Data and insights in Asia Pacific up 21%, data and insight UK and EU up 49%, our SaaS platform up 29%. And then when you look at the global economic situation at the moment, advertising revenues have been hit. Our pure amplified media 1.2 million, down 31% for 2 reasons. We actually closed our UK pure amplify arm in Q4 of last year because that wasn't growing. We saw trends around the world, so that's a large part of that 31%. And then the rest is it's taken a slight hit. As you see, data and insights not doing the same, actually growing because brands want to understand their audience even more. You see advertising start to put a little bit less on budgets. But as I said, overall, we grew 21%. If we look at the half, again, a record half for our business, 24.8 million of revenue, up 19%, 2.2 EBITDA, which is a 9% margin in line with our expectations. Growth 40% outside of business. So pretty similar picture. So revenue 19% up, EBITDA 2.2 million, down 13% as expected. Data and insights APAC 23% up, UK 45%, SaaS platform up 11%, and the media down 25%. So a really strong business at another record half for us as a business. So very excited about that. To give you an idea, our key focus on the business, said we've been cash flow positive for a couple of years now. What you can see here are 2 areas. So our EBITDA over the last few years, so 2019 minus 0.7, 1.4, 3.1, and last year was 4 million. Our profit after tax was minus 14.5 million in 2019, then 9.8 million, then 5.6, 2.2. And so our focus is to actually grow that to profitability in financial year 24. After a number of years of reinvestment, said it's growing that revenue base. It's absolutely to do that return on investment and to see that expanding margins continue. We've gone from 5% EBITDA to 7% to 9% last year because of the investment we made. It'll be 9% this year, but it's a steady increase in those percentages. We look at the financial year outlook. What we've said is 9% EBITDA margin in line with our expectations. And we've actually said our guidance will be revenue 48 to 52 million, EBITDA margin of 9 to 10%. We gave that out in our AGM in November, and we reiterated that just yesterday. So we're seeing that continued growth in the business. So very happy with that. the sales capacity, we've invested in 5 new sales roles outside of Asia Pacific in Q4. That's why especially you saw that growth in non-APAC business. So that's coming through now. So the investment's paying off. We've enhancing our board across M&A, industry experience, growing our panelists, and also moving back to a hybrid way of working from a COVID. Everybody's at home with new offices in the UK and India to support our growing team and our growing client base. Operating cash flow positive, so remains positive. Yeah, good outlook. And as I said, we've reiterated our guidance. Corporate strategy, what you'll see for the rest of this year, developing new partnerships, that drives, that's that audience builder flybys example I gave, that drives our revenues, it drives our new clients we can win and drives in new countries. So we're looking for a successful US audience builder pilot to give us a large step into that country to grow that as 3 to 4 million we're doing at the moment. We've got existing partnerships that we're growing. We signed in 22 that are growing and some new ones that are coming out as well. So that helps us grow our revenue line. Technology launches, and we've just had a major one actually in January. Again, that helps us drive especially efficiency line, improving that EBITDA percentage, and then continue to focus on growing globally. So in summary, we continue to have accelerated revenue growth. When I joined 2.5 years ago, we're about $24 million of revenue. As we said, we'll finish this year 48 to 52 million. So great revenue growth. Positive EBITDA and operating cash flow continues as it's done for a couple of years now. We're investing for the future, which we've now done, see that paying off from financial year 24. We have great employees, great loyal, satisfied customers. And for those who'd like to contact us on the SX, you find us as PPL, and there are my details and also Melinda Shepherd, our COO, CFO. And with that, I'll hand back to Mark.
Thanks, Martin. Yeah, I mean, you touched on it in your presentation. But I think it's instructive to maybe just go into that EBITDA, margin going up, but the absolute, level kind of falling quarter on quarter. There's a question around, is it gross margin degradation or cost-based growth? And I think it's more the latter from, you've presented a few times here before, but if we can just talk about some of the investments that were made in the first half of FY23, which are only going to kind of realize now in the second half and even into the back end of 23.
Yeah, thanks, Mark. So in Q4 of last year, we invested in several senior sales positions, so commercial positions around the world. So that impacted Q1, and we're starting to see with that revenue growth that now paying off. So that was one investment that we made. We also opened up an Indian office, which we hadn't had for a couple of years because of COVID. And that actually, because it's treated as a separate company, sits above the EBITDA line, not below the EBITDA line. So that's, as that was in the release, that's about $60,000. So we had those two, and those two were investment costs. We then had a couple of one-off costs. So we had a foreign exchange loss of $107,000 in the half. And again, that's a one-off. And for a UK client, we put a bad debt provision in place of 115,000 that we should see back. So that's in as a provision now, rather than any changes for our audited numbers, which will be out towards the end of February. So we've got a couple of one-off costs, which are at about 220,000. Some commercial people that we invest on that are now paying off. And then the other one that we had was before I joined, a very large UK office when the company had a large acquisition that it made, and we subleased out that office, and that was about 500,000 a year. So we saw 245,000 in this half. And that was treated as income above the line, but then it equaled itself out below the line as a lease cost. So when you look at the EBITDA, we also had a sublease cost of 245 that has now come out. So those are the cost base. But for us, the key thing is, as you mentioned, Mark, one, EBITDA still positive, going up. The other thing is that 9% margin, which is the 9% margin we finished on last year. And we said with losing the rent from the office and because we gave up that lease, and also the additional hires, we would expect to see that 9 to 10% EBITDA range for the year, and we're already on target, up from 8% in Q1. So that's why you see it slightly down year over year, but we continue with our full year guidance. As I said, at the low end, 9% of 48 million is still up on last year. So we are fully expecting, our guidance is saying our EBITDA will be up year over year. So that's where we're sitting. We're very pleased with the businesses at the moment. We're ahead of budget and our own expectations.
And then another question from the audience, Martin, on R&D spend. Are you expecting a similar spend to FY22? They quote 2.2 million for the 2022 years. Is R&D spend going to be roughly kind of in line with that, or does it change with the big release that you referenced that you did in January?
No, it's absolutely in line with the last couple of years. Again, very cautiously, where we look at investment and we don't invest ahead of the revenue curve. And we've always done all of our development work within our cash flow and within our capability that we have. So no, that is not going to increase.
Okay. Then a question on the SaaS revenue. The person knowing that's back above 1 million, but they're wondering, is there anything seasonal in there? And has the Asian partnerships finally starting to become visible from a revenue contribution that it's actually noticeable? Is the SaaS thing just more about when contracts fall between quarters that it looks seasonal, but it's actually just the normal billing cycle?
Yeah, that's a good question. So we talked about that at the AGM. In actual fact, one of our large SaaS clients, they themselves had a data outage for their membership clients in Q4 of last year, towards the end of it. And that, because they had an outage, had nothing to do with our system, that impacted our Q1 numbers. Otherwise, Q1 would have been strong as well. So we're seeing that SaaS revenue just grow. Yes, we have some seasonality in the business because we're still 60% in Australia. So you see Q2 being stronger, then followed by Q4, Q1, and then Q3. But that's Australian seasonality. But our SaaS revenue continues to go from strength to strength. And actually that blip that we saw in Q1 was just because one large client had a data outage. So as we add more SaaS clients, then that and more audience builder clients specifically, that SaaS revenue continue to grow. And the question relates to somebody that we signed last year. It's called the Asian Parent out in Asia. So they have access to about 30 million parents with children across multiple countries. We went live initially in one country with Singapore. That's going well. It's not one of their biggest markets. And actually, we're now at the stage that we're talking to them about rolling out into additional markets. I think specifically, I was on with Keith, our head of Singapore, last week, and specifically Indonesia, which is a much bigger market, much bigger data and insights market as well. So we should see the Asian Parent revenue grow as we roll out new countries.
Speaking of data and insights, we've got another question on that. The strong data and insights growth, is the stronger demand coming from particular customer segments, or are the sales from customers, upping their spend for understanding kind of key markets, or is it more winning business, from your competitors, so they're kind of new customers into the Pureprofile fold?
It is actually all of the above. So we've got very low market share in countries outside of Australia. So we're winning that market share from competitors. That's nice because that makes us macroeconomic proof, because we're winning new clients, and if they're spending, I'll make it up, at $8 with us, and yesterday they spent $10 for somebody else, it's a new $8 for us. We had no idea that you had a budget of $10 yesterday. So that low market share that we've got is growing, and we're winning from clients in those spaces. And there's tailwinds behind data and insights as well that's carried on since the COVID years. And especially now, as I said, with uncertainty around economies, companies are carrying out more research, more analysis of their data and of their consumers, because they want to maintain or potentially win market share in the current space. So that gives us a particular tailwind. And then also we're better at what we do. So we're fine-tuning all the time our solutions, our SaaS solutions, but also how we approach clients and how we work and support clients. So that continual improvement actually increases the revenue side as well for the SaaS product. So it's all, and more focus on it for us as a company. So it's all of the above, Mark.
Okay, great. And in terms of, if we kind of look longer term, and I know it's a mix of, how fast businesses grow and what their kind of contribution to the overall mix is. But I mean, the SaaS revenue, I'm guessing, is somewhere around SaaS margin. So, as that continues to become a bigger slice of the pie, should we do you expect a kind of continued upward trend in margins, over the next 1 to 3 years?
Yeah, a good question. So an absolute, as I said, absolute focus for us as a business is to be net profit profitable, statutory profitable in financial year 24. So that is looking at how do we increase those EBITDA margins, and it's a combination of different things. So firstly, it is by doing what we do even better. So improving efficiencies. So we're adding dollars of revenue without adding either people dollars in managed services or cost dollars in our SaaS product. So that's absolute focus for the business, and that's why you've seen that EBITDA percentage increase. The type of clients that we work with as well. So again, not looking at just growing revenue at any cost, even if it's low gross margin, to your point, actually adding profitable high gross margin clients. We're at that stage where we are number one in certain markets. We're really respected within the space that we work. So we have the ability to lead on that respect. So we're doing that. And then thirdly, by increasing or changing the mix of products that people are using or solutions that clients use, and adding in those SaaS solutions and growing that revenue stream. So it's all element, everybody plays a part, from salespeople and what clients they talk to, operations, if it's a managed service, how they work with clients, how they source that data and deliver that project, technology around efficiencies, etc. And it's a continual evolving piece for us, but one, as I said, that 2 years ago, we were sitting we finished at a 5% revenue, EBITDA margin, sorry, and this year will be 9 to 10%. So doubling EBITDA margin over a couple of years, we're really pleased with. But again, I'll reiterate, everything that we do is done within our own means. We've got a healthy cash balance, we're cash flow positive. we weigh up all the time return on investments. Could we hire 5 new SaaS people in a number of countries and actually launch that? Absolutely. But is that going to be a guaranteed return on investment? Is that going to risk what we have built and what we are doing? So we would much rather conservatively grow that EBITDA line, whilst actually, you know, the revenue line over 20% is very healthy growth.
And Martin, we're just up on time there. Actually, we've gone slightly over. But thank you very much for coming back in and giving us an update on all things PPL. And yeah, if anybody's got any further questions, please feel free to reach out to Martin or indeed Melinda. Martin, if I could ask you to please stop sharing your screen, because I do know we have Paul from Norwood Systems waiting on the sidelines here. Paul, if you want to start sharing your screen, I'll let you know.
Sure.
Coming through now. Yeah, and if you want to go to slideshow mode, just I might just get it a little bit bigger. Yeah, there we go. Perfect.
Fantastic. Can you hear me?
Yeah, your audio sounds good, Paul.
Great. Well, hi, everybody. This is our first time at presenting at Coffee Microcaps. Delighted to be here and excited also to show you the progress that Norwood's been making. I guess just need to offer the statutory disclaimer to begin with. And what I'd like to do first is talk a little bit about the Norwood story. So we've been around a while. You could characterize Norwood as a very technology-centric company. We've been working on finding product market fit for a number of the different innovations we've been doing. We succeeded in a mini way about 5 years ago with a telco-focused voicemail service where we very quickly got a large cornerstone client in Spark, New Zealand, which used to be the old Telecom New Zealand. But we've been working through, you know, a variety of different things over a long time. Not all of it's been easy going, but gosh, we're feeling like we're in a very, very good spot at the moment. And the main reason for that is 3 years ago, we made a kind of decision or pivot to move from legacy trailing edge services, as we describe them, for voicemail, which is a sizable market, but tends to be dominated by 2 large international players. We've learned to move more into the domain of conversational AI and generative AI technologies. I have to say, way before it became fashionable over the last 60 days. But the thing that we are focusing on today is a platform called CogVoice, and CogVoice enables communication service providers or operators to look at ways of how they can make their voice networks in particular valuable again. And I'll revisit CogVoice after going through some recent results that we've had as a company. But what I want you to think about is operators with these legacy voice networks, they're sitting there. Operators are kind of actually quite receptive to the idea of thinking about how they can make more money out of those legacy networks. So we've had a fairly healthy 12 months, as evidenced by the share price, although admittedly off a very low base. It's fair to say that we've completely rebuilt the governance structure of the company over the last 12 months. Frustrated that we were kind of in a space where we're really going sideways and not upwards. The whole board has changed over. 2 very strong strategy people out of the UK, and Dr. John Tarrant, who also has now taken a kind of real cornerstone investment position in the company. And most recently, we appointed Ronan Dunn, who's very, very senior guy in the telecommunications space. He used to be the CEO of the Verizon Consumer Group and also previously the CEO of O2, both major operators in the US and the UK, respectively. So we've got this huge leadership depth. This team's been acting as kind of mentor to me and advisors to the team generally on how we can take the technology we've been working on for the last 3 years and really make it grow. I guess all of this needs to be viewed through the prism of a technology platform that came out 60 days ago called ChatGPT. I'm going to assume most of you have heard of it, so I'm not going to go back and describe exactly what that does, but it's essentially a conversational generative AI platform that really has captured many, many people's imaginations about the impact of AI. And so we're in the middle of marketing our platform through the stimulation and understanding of what these platforms can do as helped by ChatGPT. And because we've moved from these legacy trailing edge services to really innovative offerings, we've actually seen what we hoped, which was a huge increase in our sales pipeline and much, much further engagement with particularly service providers, but also the large global partners that could co-sell these solutions for us, being the hyperscalers, the large cloud providers. Just operating highlights over the last 12 months. September quarter was great. We banked $500,000 of revenue, which actually is an all-time record while I've been in the company. And more significantly, we finally got our platform CogVoice released out to the market so that we could start doing proofs of concept with it with selected operators. CogVoice is a platform. It also has applications that sit above the platform. And we've been working on 3 initial applications to really create end-to-end package services that operators very easily could go and take and deploy inside their networks. Now, we, through one of our partners, Infosys, got through to one of the largest operators in Australia early in the calendar year 22, and we spent 6 months doing a very detailed proof of concept with CogVoice. Was really very successful. We reported that to the market. We're right in the middle of very active joint workshops, plans, negotiations to productize and launch that service. And so we're super excited about that. That ought to be the first deployment of a conversational AI platform anywhere in the world by an operator targeting consumers. We also, renewed our contract with Spark New Zealand. About 5 years of relationship under the bridge with them now, and we have just refreshed for another 3 years, which is great, and that relationship's going very strong. Over the last 12 months, we added a significant partner in Infosys, really very global presence. They've got, I think, 250,000 employees worldwide, projects everywhere. You may have seen them in the Australian Open doing all the IT services for all the computer graphics during the games. And they've been great. We've managed to win a couple of nice projects in Europe and Australia, and actively partnering with them to see where CogVoice can be deployed elsewhere with some of their other service provider partners around the world. And as well, by ourselves, we're in the middle of an international face-to-face marketing program where we're targeting a lot of potential service providers, large and small, in all the sort of major geographies, locally here, but also in North America and Europe. Just to give you some highlights of the most recent quarter, was really a great quarter for us. We achieved a nice turnaround in terms of operational cash flow, actually generating cash compared to the outflows that we had in Q3, and more significantly, the similar quarter in Q4 2021. We got the contract variation for Spark with this extended pricing, as I referenced before, and we secured very nice new purchase orders just for FY 2023 to give you some sense of the scale of how much each relationship with an operator might be worth to Norwood. Depending on the different business models and the sort of things that are being sold to operators, it could be sort of tens of thousands of dollars to hundreds of thousands of dollars to millions of dollars now. Spark is, a relatively smaller operator in the worldwide stage. To give you an idea, some of the other operators in the US, they have something like 150 million subscribers. So relationships with them could yield revenues that are substantially larger than what we're seeing from Spark, as an example. The 2 deals that Infosys brought to us, early last year, calendar year. We've now completed all the R&D development for it, banked all the progress payments, which has been great. And in particular, one of them is a SaaS project, so we're receiving ongoing revenues from that. But the other is now moving to this productization phase of what we did following on from the proof of concept project. We also received a very helpful grant from the Australian Tax Office for our R&D investment. And just in this last quarter, we appointed Ronan Dunn, even as late as last night, a very useful strategy session with him. So he's really actively engaging with us and mentoring us and helping us understand how to engage with the global operator market, which is really priceless advice for us. So we're working hard on building interest in CogVoice. We are seeing gratifying responses to that from all sorts of operators around the world, and super excited about calendar year 23 and where that will take us. So what is CogVoice? I thought it would be useful, just to, having gone through the sort of results and things, just to go through what is it that Norwood does and why is it that you may want to pay attention to us. So CogVoice is a revolutionary AI voice platform. And we've really shaped this so that it can deliver unparalleled capabilities and performance for voice calls to operators. And what CogVoice does is it engages with people calling in on the operator network and behaves largely like a human being would. So you can think of voice agents like Siri and Alexa. They're largely command and control type interfaces. You kind of bark a command at Siri and it does something for you. I think it's fair to say you can't really have a meaningful conversation with Siri today. You can't go back and forward and start exploring things. And you can certainly do that with something like ChatGPT, but it's a lot harder to do it on a voice call. And one of the things that operators need in particular, in addition to this kind of performance profile and scalability profile, is they need to be able to see that the profile can be deployable inside their network at a price point that allows them to offer it as some kind of bolt-on service to their customers. And so there are certain kind of constraints to that. It can't be a sort of $50 or $100 per month offering, because they'll get extremely low take-up. And so we've crucially designed this with very high performance and also very low cost, and I'll come to that in the next slide as well. So, ChatGPT's come out over the last 61 days. Why are we different? In some ways, we're very similar to ChatGPT. We use the same underlying technologies. I guess a very good call on our part was a full 2 years ago, I saw that this space would become quite interesting. And so we reached out to OpenAI, and we actually got what they called private beta early access to all of their APIs well before they actually launched them, I think, which was in October last year, the year before. And so we've been sort of going hammer and tongs at using the models and AI platforms that they have to work out how to build new cool things and shape them in a way that actually will be of appeal to operators around the world. There's two very important differences I really wanted to emphasize between CogVoice and ChatGPT, and they revolve around the ideas of speed and cost. So if you are using ChatGPT and just playing with it, I'd encourage you to take out a stopwatch and just measure how quickly it takes to respond to any prompt or question you ask it. And it's typically seconds, many seconds. When you talk to somebody on the phone, you're naturally expecting that person or entity to answer you like Siri or Alexa does reasonably quickly. So it has to be a lot faster than many seconds. And so we've gotten this down now to where it's answering calls in a fairly natural, real-time way, as you would expect. Another more important point probably is that it needs to be a lot more cost efficient than ChatGPT. You can get a free version of ChatGPT, but were you to roll out their commercial version on Twitter and other fora, it's estimated that it will cost, and I think people have shown screenshots to this effect, $42 US per month to use ChatGPT. And again, thinking about an operator, the likes of our large mobile operators here in Australia, they'll be wanting to put an offer into the market, which is probably around the several dollars to $5 price point, and you then have to work backwards from that. So what's our cost of goods going into that? And the good news is we have, over 2 years of heavy R&D, worked out exactly how to do that. And so ChatGPT is great because it's stimulating the market, making people aware of what's possible, and then we can come along and actually highlight how you can literally engineer the underlying models that ChatGPT uses to also deliver services that are super fast and very low cost. And this isn't easy to do. This has taken years and years of investment with a fairly decent R&D team going hard at it. So CogVoice builds applications. We eventually also will launch as what we call an SDK, a software development kit, to allow operators to build their own applications. We thought it was useful in the short term to build 3 shrink-wrapped applications that are kind of end-to-end, doing everything that they need to do so that the operators can take them and easily slide them in. We have 3 of them on the boil at the moment. I can talk to you about one of them, but the other 2 are covered by NDAs, and we will let the selected operators that we're engaging with for those applications speak to them as they launch them in time. Don't really want to take away their thunder. But what I'd like to do a little bit is just give you some examples of what the very first application we built, which was called Personal Assistant, and how it can behave and deliver value to customers. So Personal Assistant and all these sort of applications is really quite a new thing. The operators don't deliver these sorts of capabilities today. If there is conversational AI technology inside operators, it's typically found in their call centers, where they're using it internally to answer calls and to take load off the existing human agents. That said, when we talk about, would you be interested if we could make it low cost enough and fast enough and scalable enough to be deployable for your consumers, they all sit up and take notice. And so we've had pretty interesting sets of discussions over the last 6 months roughly, and ongoing to do that. And CogVoice, as I mentioned earlier, it sort of really deals with these speed and cost parameters that the operators are very focused on. Because we've got this track record and relationship with Spark New Zealand in particular, and because of the learnings we have and the way we're able to communicate what this platform can do for operators, we tend to be accepted fairly readily into the most senior levels inside operators. I've personally managed to have discussions with CEOs of large US operators. Ronan joining us recently, I think, is a probably pretty good signal that we're held in reasonably high regard. Yeah, so what I'd like to do now is probably give you a demo of what Personal Assistant can do, and just play a short video for you that gives you some idea of what the level of fluidity and interaction is.
Nice to hear from you again, Steve. I can take a message, route your call, or book a meeting with Richard.
Well, I'd like to book a meeting with Richard on Thursday afternoon.
Certainly. Is 2 p.m. or 4 p.m. better for you?
2 p.m. at his office works for me.
Thank you. I've booked that for you.
So there's a fair bit to unpack there, but you can see the conversational agent knows about Steve's contact details, or Richard's contact details, I should say, and recognizes Steve when he calls, and is also able to, because he's probably granted access to Steve, to actually book times in his diary automatically. That's a very, very small window into the kinds of things that these sort of AI agents can do. The sorts of other applications broadly would revolve around enterprise-focused applications, small, medium business applications, and pure consumer applications. And so this can span the entire gamut of operator segments where they're targeting consumer, small business, and enterprises. But this is a really nice starting point. This is a product that, when you think about it, can provide personal assistance to everyone below the 1% of employees inside corporates that can afford a personal assistant or an executive assistant, and save valuable time during the day. And it's able to do a lot of different things, the typical sort of tasks that a human assistant normally would perform. So I think we're coming up to Q&A time. I'll just move on to the summary. So it's been a very good quarter for us. The last 6 months to a year have been one period of really building enormous momentum for the company, and with our new leadership at the sort of governance level of the board, and also with Ronan as an advisor, and with John Tarrant supporting us as a cornerstone investor, and with strong relationships with our existing clients, and with, in particular, putting our CogVoice application to the test in the market and seeing that it's getting spectacular results, leading to near-term contracts, is a very, very exciting time for Norwood. So with that, I'll invite questions.
Thanks, Paul. Yeah, we've got one in talking about, obviously, Chat GPT and OpenAI and Microsoft's 14 billion Australian, 10 billion US. How will that potentially impact on Norwood's business model, relationship with global CSPs, or at all? Is it Microsoft be going down some other use for ChatGPT and OpenAI compared to the kind of targeted approach that you're doing?
Well, we can only guess what Microsoft's going to do, but what they've stated is, I think, or there's certainly speculation that they will build ChatGPT-like features into all of their Office suite applications as one starting point. I'm reminded of Clippy, the intelligent assistant that they had 2 decades ago. We probably will see a rebirth of that. Their license for the OpenAI technologies is for a replica of the APIs and models that we're accessing on OpenAI's servers directly, servers which have been funded by Microsoft previously. And so when you go on to the Azure for OpenAI services website, you'll see that they make available the same models exactly that OpenAI have. And so we'd have basically 2 pathways to use the OpenAI models, either directly through OpenAI or through Azure through a different pricing structure. And it's interesting, the Azure model is actually better for us as you scale the services up to hundreds of thousands or millions of subscribers, just because of the way they actually price certain kinds of models that we call fine-tuned models, which is where we've done all the work to actually take a baseline OpenAI model, and then we train it up with our own data to actually make it do different things faster and cheaper, basically. Well, actually not cheaper, but certainly faster. And so when you look at the 2 economics, it there's a crossover point at about 30 or 40,000 subscribers where Azure becomes lower cost for us, and OpenAI becomes a bit more expensive. But OpenAI is a great, very linear sort of cost structure for us. There's very little startup cost, and it's all basically a SaaS kind of use it as you go type model. At another level with the operators and the CSPs that we're dealing with, certain operators have strategic relationships with different cloud providers. Could be AWS, or it could be Azure, be a number of different ones in parallel. And it helps enormously for us that they've got those relationships in place already, because often, the discussion goes down the pathway that we can transact with the operator without putting a master services agreement in place, which might take a long time to set up. Lots of due diligence, lots of heavy lifting, and instead use the cloud providers' master services agreement through their marketplace facilities that they have available. And it turns out, indeed, for a couple of the operators we're chatting to, a very, very lightweight way of us transacting with the operator is to give up 3% of whatever we're selling to them in terms of revenue, and just go down that pathway. It's almost like an app store, in fact, where they're providing all of the billing and main agreements in terms of contracts with the operator, and we basically get streamlined onto that. to get into that, you then need to go through a bunch of security reviews and architecture reviews, which we're in the midst of with a couple of the large hyperscalers currently.
And in terms of Cogvoice and Spark New Zealand, which you've had a long-term relationship with, is there a possibility of them becoming or using it as a kind of initial kind of large-scale client, or are they happy with the the services that have been ongoing from Norwood for a couple of years now?
Yeah, look, I don't want to comment on commercial discussions until with Spark in particular, until we reach some point where they're happy for us to talk about it. But I would say we're having discussions with operators all over the place, which may or may not include Spark. Certainly, they've been a great client of ours, and we look forward to an ongoing sort of solid relationship, and excited to see where that all leads. There are some, if you look at the sort of largest two operators in Australia, they're both roughly 4 times as large as Spark. So getting one of them on board would be rather nice as well, in addition to, not instead of. But then you look at the sort of North American market, you have operators there that are 150 million subscribers that are roughly 10 to 15 times larger than our largest operators here. So there are a lot of different pathways for us to sort of take this technology and commercialize it. What has been striking when we go and talk to operators all over the world is they all say to a T, oh gosh, we actually haven't ever seen anyone do anything like this. And so it seems for now that we certainly have a little bit of a jump on the market, specifically for these sorts of telco operator-led AI conversational services for call completion. There's obviously a huge amount of activity in the AI market generally, and to some degree that sort of benefits us because there is such a broad application frontier of all the different things you can do with it, that people are going into various different niches, and some of them aren't really niches, they could be quite substantial. But because there are so many different possible applications, there isn't one application that everyone's intensely competing for. There's a lot of different opportunities to profit and make money from the advent of these charismatic new technologies. My phone's going
we're just pushing up on time, and I see that Wayne has joined us from San Francisco, so I think we might just leave it there rather than trying to squeeze in another question. Thanks very much for joining us this morning, and I believe the 4C went out this morning. If anybody wants to have a look at it, it went out on the ASX announcements platform this morning. So if anybody wants to delve into the numbers, they'll see it there, or indeed reach out to Paul at the email address that's been up on the screen during the Q&A. So Paul, thank you very much. And if I could please ask you to just stop sharing your screen, and then we'll get Wayne Arthur, CEO of Skyfii, to start sharing his. Good afternoon, Wayne. I think I've got that right. It's afternoon in San Francisco.
It is, Mark. Good afternoon. How are you?
Good afternoon. I can see the cover slide of the deck now, Wayne, so you can take it away whenever you're ready.
All right, great. Thanks very much. Well, thanks everybody for your time. Can't see you all, but I think the rain that was pouring in Sydney for the last, must feel like 3 years, has just stopped coming down in San Francisco. So share your collective pain over the last little while. As Mark's mentioned, we just released our 4C yesterday, so the full copy of the 4C and the commentary is up on the ASX at the moment. And what I've done is I've just redacted some of the results into this presentation for today. But I'll plan to take 15 minutes or so just to present, and then leave 15 or so minutes for questions after that. For those of you who don't understand the business, Skyfii is a data services business. At the core of the of the business and the revenue offering is a platform that we've built, which is called IO. That platform essentially has been developed to integrate and ingest data from a variety of different technology sources, some of which I've listed on this slide here. So, typically we are working with physical venues, public spaces, areas where there is movement and flow of either people or vehicles or some sort of object. And our sole purpose in life is to help those venues using that data understand what's going on. So where are people moving? How often are they visiting? What are the areas of congestion? In the case of airports and train stations and stadiums, we're helping them understand queue, wait times, bathroom occupancy, journey maps, heat maps, all those kinds of things. So, we work with over 200 different data types generally today, and we've listed about 20 or 30 of those on the left-hand side here. We're in about 14,000 venues around the world, ranging from shopping centers to airports, universities, hospitals, restaurants, and more recently starting to penetrate the stadium and casino vertical as well. If I go to the next slide, generally the use cases are relatively similar, but with some nuance depending on the type of venue that we're working with. Just to be very clear, we generally are the software layer. We rely on the venue owner to either install or procure the infrastructure, such as the cameras or the Wi-Fi network or the mobile app or the CRM tool that we're integrating with. So we're not, to be very clear, we're not a hardware manufacturer or an infrastructure provider. We're generally the software layer that layers over the top and collects and aggregates the information. But in some cases, we are asked to provide a full end-to-end solution, which can include infrastructure, which we procure from third-party vendors. So, but generally the use cases, are relatively straightforward and similar. We're providing queue metrics, visitor counts, occupancy metrics. We're helping them understand things like space utilization, or in the case of airports and transit hubs, it's passenger flow. Big one in airports is understanding curb to gate journey times. Airports are really focused at the moment on improving efficiency, right? So how quickly can we process passengers from ticketing through security and getting them into the concession areas or the retail areas where they can spend some time and money. So our job in the airports, for example, is helping them, monitor and improve the journey time from when they arrive to when they get processed to the other side of the security checkpoints. In places like quick service restaurants, it's a little bit more around observing the whole restaurant operation. So it's less about how many people are sitting in the restaurant. It's more about how long is it taking for food to be delivered from the time that it's ordered to the time that it actually arrives on someone's plate or gets picked up by the food delivery app orderers or people coming through the drive-through. So it's more of a whole of operations view that we're providing. So same platform gets deployed across all these different venue types, but the use cases and the reports sometimes are a little bit customized, but for the same outcomes and same use cases in most cases. Quick summary then on just how we perform for the quarter. So I've been talking a lot about, a couple of guidance metrics that we've provided. Number one, we've said that we would be, and this was prior to this quarter's result, we talked about getting to cash flow break even this year. We talked about positive operating cash flow. We've talked about a 20 million ARR threshold being met in this financial year. I'm really pleased to have announced yesterday that we actually got to cash flow positive in the second quarter. We're actually cash flow positive for the first half. And we expect to maintain, a cash flow, at least cash flow break even moving forward. Cash receipts were up, quite remarkably over the quarter. A lot to do with outstanding collections that we had not managed to collect in the first quarter, but managed to collect fully in the second quarter. We also had a fairly large customer pay us upfront for a deployment, about $1 million in advance. So that did bolster the cash receipts a little bit more than usual. But still, if we netted out the upfront payments, we still managed to deliver cash flow positive result for the first half. So operating leverage is starting to come through, which is probably the most pleasing part of our quarterly results. Cash position has improved. From a revenue perspective, we're up quarter on quarter from an operating revenue perspective, but also from a recurring revenue perspective. And ARR is also growing as well. We closed the quarter with 16 million in ARR. That's obviously a forward-looking 12-month ARR view. But what's not baked into the numbers yet, but is already contracted, is there's another 2.2 million in incremental ARR that has been confirmed, which we expect to actually be to go live and to be implemented in the second half. So really 16 ARR at a point in time at the end of December 31, more like 18.2 as we stand today. Other than that, we're seeing a lot of demand in the three core verticals that we're focused on, which is retail more broadly. It's shopping centers and fashion retail, as people are obviously well and truly back to normal life. Airports and transit hubs, which have obviously become overrun in what's being called revenge tourism since the bounce back from COVID, and they're all looking for security checkpoint systems to help them alleviate massive wait times as people are getting processed in these airports, particularly the busy ones. And then the third core vertical that we're working on is QSR or quick service restaurants, and we did announce during the quarter a large initial contract with McDonald's in the US, which I'll talk about a bit more later on. Outside of that, though, we are focused on and on track to deliver 20 million ARR by the end of June 30. And we're also anticipating continuing to deliver at least a cash flow break even, but a positive EBITDA performance in the second half. So more specifically then, this is how the quarterly results played out. We've used last quarter as the reference point, and then also made a reference to the previous corresponding period, which is Q2 of FY22. So you can see here, total operating revenues up 5% quarter on quarter, down 5% on last year's result, largely due to some CapEx projects, which are generally not cyclical. So we expect to pick up more CapEx in the second half than we did in the first half. But pleasingly, recurring revenues up 4% quarter on quarter, up 10% year on year, essentially. ARR up 2% quarter on quarter, and up 6% year on year. So, pleasing results from a revenue perspective. Cash collections, as I mentioned, and cash at bank position grew 50% quarter on quarter and 23% year on year. So we've managed to get our collections back on track. As I said, we also did benefit from an upfront payment from one of those customers that we'll talk about more in the next quarterly. Operating cash flows were positive as well. So that's up significantly, obviously, based on the first quarter's result, and was the reason we can say not only was operating cash flow positive for the quarter, but we actually finished cash flow positive for the first half as well. And then I spoke about cash receipts being up largely just due to collections coming through on time, which doesn't always happen. We do sometimes get stretched by some of the bigger customers, and then that upfront payment of 1.1 million, which occurred during the quarter as well. Importantly to note, we've also managed to reduce churn over the quarter, which we expect churn to move around, but generally, we were seeing in the past 12 months a little bit of latent effect from COVID, as businesses either didn't open fully or some didn't open at all. And so we've had a little bit of latent effect from the effects of COVID, but we expect that that's normalized now, and we're back to sort of pre-COVID churn levels, which is around about 2%, which we think is pretty good. Or looked at another way, a 98% retention rate, which we think is really strong. So a little bit more detail there on the cash flow from operating activities. As you can see, the trend over the last couple of years, and importantly, even net of that 1.1 million, which we received in upfront payments during the quarter, we still delivered a cash flow positive result. So I've been talking a lot over the last 12 to 18 months about a couple of things: bringing the company back to cash flow break even, and in this case positive, bringing EBITDA back to a positive, which we expect to deliver in the second half of this year, and then demonstrating true operating leverage, which we haven't managed to do until now. And so that's starting to now come through, and this is evident in this quarterly result. So we expect to maintain that moving forward. In terms of the contract wins, we talked about in the quarter, so I'll talk about McDonald's separately. That was a significant contract which we wrote in the QSR space, but generally contracts, the contracts amounts is still, focused on the three core verticals. Retail property was the biggest contributor in terms of our new contracts delivered during this last quarter. The balance being made up by airports and QSR, which is at this moment McDonald's mainly. We wrote 3.6 million in total contract value in the quarter. Not all of that obviously fell into the quarter, but that's over the course of generally 3 years. And you can see the split there in terms of the contribution, which we expect across those three core regions of APAC, EMEA, and the Americas. So key contract wins announced. These were two of the announcements that we did make during the quarter. And we've been generally, announcing contracts, obviously, that are either material in name, such as McDonald's, or material in value, which generally means it's sort of 5% or more of our revenues. The McDonald's deal, as I sort of spoke a bit more about in the first quarter, is the first of its kind. Basically, McDonald's have been searching for a solution to help them understand their in-store and drive-through operations. We've deployed a solution at 4 of their restaurants, just 4 at the moment, with the contract to expand to 8 over the course of 3 years, where we're actually helping them observe all of their service delivery channels, and there's 12 of them. So drive-through, all the mobile app, delivery platforms, obviously walk-ins, and then people dining in are generally how the 12 is made up. We're using a LiDAR solution that we've built for them. Obviously, again, the software layer is the main component that we're delivering for McDonald's to help them observe, how long it's taking food to get prepared, and making sure that food is actually delivered A, on time, and B, with the quality and the freshness that McDonald's is known for. So we've provided that reporting system to them. It's helping them to monitor things like drive-through dropouts, abandonment, and all those kinds of metrics as well, which are all things that McDonald's is hoping, and we are hoping, will expand across a much larger footprint across their estate. But equally, it's a product offering that we are now productizing to take outside of McDonald's to the broader QSR landscape. So QSR is a key focus and a core vertical for us at the moment. Airports has been a strong growth vertical for us for a number of years. As we acquired CrowdVision almost 2 years ago now, that gave us a really strong footprint, particularly in North America and Europe. So that's continued to pay dividends for us. We signed collectively about $2.8 million worth of new contracts in the airport vertical in the Q2 quarter. Some of the notable contract partners included Miami Airport, Newark Liberty International Airport, which is a brand new terminal that we've now launched with them, and then Phoenix in Arizona, which is another major busy hub in the US. So three key contracts there that we announced during the quarter in the airport vertical. So then, as I mentioned, the outlook, aside from continuing to maintain an operating cash flow break even as we move forward, we expect obviously to continue to grow revenues. So I wanted to just give some flavor to the sort of revenue pipeline. We generally post this pipeline slide up as a forward-looking pipeline view, and this only really relates to opportunities that are in our pipeline that are at a sufficient stage. In other words, we've provided a proposal, we've qualified that the lead is real, there is actually a budget assigned to the opportunity, and then it gets obviously tighter as you go down the funnel. So collectively, if we were to write everything in the pipeline today, we'd write $26 million over the next 12 months. Unlikely we're going to get all of the business, but we obviously try to work these deals through. What I try to draw people's attention to really are the bottom two sections here. contracted, negotiation, and committed. That $2.2 million, that's banked basically. The only variable there is when is it going to fall, and that's a function of the supply chain, the installers, the client actually giving us access to the site to install the software, or any number of those factors. So that's the only variable is timing, but the 2.2 is contracted and committed. The 6.1 in the client evaluation stage then is the one stage above that, which is at a point where we've been down selected. We might be one of two vendors in the race now, or we're in a pilot scenario, or we're about to submit a contract for review. So it's at a much more advanced stage. I would say our success rate of that would be 65%. So we'd expect to write about $4 million at least of that amount of money over the next 12 months. So that gives you some idea of what we're staring at in terms of pipeline. And then in closing, then what we're mainly focused on is meeting or exceeding the guidance that we've provided. So we did provide guidance prior to this quarter of achieving cash flow positive or cash flow break even. We've done that already. So we've done that 6 months ahead of guidance, which obviously we're excited about, and we're going to continue to maintain that moving forward. The 20 million ARR, as I spoke about, we finished Q2 December 31 with an as-at ARR of 16 million, which was delivered up until that point. I've already stated in today's presentation that based on what's already contracted in the second half, we expected that 16 is already 18.2. So we're looking to fill the gap of 1.8 between now and June 30 to meet or exceed the guidance of 20 million ARR, which we do expect to do. We'll maintain cash flow break even or cash flow positive over the next 6 months and beyond. And then we expect to deliver a positive EBITDA performance in the second half. Outside of that, then we are seeing the majority of the new opportunities in the pipeline being generated in our international markets, which is obviously by design. We've been investing in the North America and EMEA regions for the last 18 months or so. So it's good to see that investment starting to pay off. We expect the international markets to outpace our ANZ or APAC region this year, that we should get to somewhere around a 50-50 contribution between APAC and the international markets in terms of overall revenue contribution for the year as well. Outside of that, cash management, obviously a key focus to make sure that we maintain that cash flow break-even position, but also, in terms of how we invest and in terms of our collections piece, which was a really strong result in Q2. We want to maintain that momentum moving forward. Outside of that, though, I've spoken about the 3 core verticals, which is where we're focused in terms of marketing and sales activity, being retail, airports, and QSR. And you can expect to hear more announcements of new contracts in those 3 verticals coming up in the next quarter here. So with that, I'll stop speaking, and I'm happy to take any questions, but I do appreciate everyone's time.
Thanks, Wayne. Just a quick question. Obviously, inflation racing ahead globally. I'm just wondering how you're managing, when contracts come up for a renewal now in 2023, or even in the first 2 quarters of last year. Pricing, those renewals, and what kind of inflation adjustments you're putting into contracts. Moving forward for existing customers, or what you're building into for new customers signing on now.
No, it's a good question, Mark. Look, we actually took the posture. I don't know. I'm sure everybody on this call has been the recipient of a price increase from a service provider, or just in general, obviously, to meet with inflation. Generally, people have been raising their prices, and we've done exactly that. So we actually have raised our base price on all products to maintain margins in excess of CPI. So we are expecting customers to take on board that inflation hit. So that's our general posture. And our view is obviously to make sure that we maintain margins, and hopefully the result that we've now shown in the Q2 quarterly is testament to that. That we're focused on margin, on definitely margin, stability or at the very least margin gain, to make sure that we're delivering some operating leverage moving forward. And we've started to do that now. We want to maintain that moving forward.
And then, yeah, kind of a corollary to that question is we saw Microsoft's in I guess politically correct terms saying customers are optimizing their digital spend, I think was the phrase they used. Have you seen any of that from your customers? Because I know some customers, take an entire, suite of products from the Skyfii stable. Others might be just taking, one currently, and obviously, you're obviously trying to upsell to those. But, when you're talking to customers, are they kind of saying, we're happy with the suite that we have now, or are they like, actually, we're going to, take 3 out of the 4 because they're really core to our business?
Yeah, look, it does vary. I think the way I would answer that is certainly in the retail landscape, where you've got large property groups that have got, as to use your example, they've got relationships with Salesforce or Microsoft or Amazon or whoever it might be. We've taken the approach that it will incrementally build over time, and we do see, and we can show results where in customers like Westfield, GPT, we've gone from revenues of X to revenues of 3X over the course of 5 years. We've demonstrated that blueprint a number of times, and so we generally see that revenue, or basket size, or increase in customer share of wallet increase over a period of term. And I don't think there's been one renewal in our business that hasn't at least maintained the existing revenues or grown. So I think the answer is, in short, yes. I think once we're embedded, it's generally easier for us to upsell more services to that same customer rather than there be erosion. In the airport space, at the moment, what we're seeing is just a bit of it's a needs must situation. They are, particularly in the US and Europe, over the holiday period, they just got found wanting. There was as I said, a bit of a revenge tourism element to people's travel. Airports weren't prepared for it. They're still very understaffed and have not put in the right technologies to cope with the congestion of passengers. And so we're getting a whole lot of activity now from them, specifically around wait times and passenger processing. I don't think the lens is going to go beyond that until they've solved that initial issue. But again, historically with airports as well, they are intrinsically loyal, right? Once you've embedded yourself, it's relatively bureaucratic, and so you go through a lot of hoops to become a preferred partner, and you generally don't lose that status unless you really do something wrong. So the opportunity to upsell is there for us. Does that answer the question?
Yeah, it does. Thank you. I think especially on the airport side, it's let's solve the passenger congestion issues first before we start looking. Obviously, you mentioned the big concession spaces at most major airports now, and you can also look at dwell times there, and they can start optimizing that. What do they call it? Non-aeronautical revenue. But as you say, that's probably not a major focus for them right now, but could be 6 to 9 months down the line when hopefully resources have upscaled and some technology has been brought to bear on moving people through airports efficiently.
Exactly right. Yeah.
I have email question in here. I know you have kind of covered this in the Prezo in a bit of detail, but maybe it might be instructive just to go back on it again. When you refer to sustainable cash flow break even in the second half of 2023, is that referring to operating cash flows or the operating and investing cash flows?
Yes, no, both. Referring to both.
Okay, cool. I think they just wanted a bit of clarification on that. And then a question on the McDonald's initiative, and you're saying you're looking at productizing that offering so you can take it out to other similar businesses and get thinking of like young brands here. What is there in terms of restrictions on IP or being able to take the learnings from you know, these 4 stores or, you know, potentially the next 8 stores, and, you know, designing a model that, you know, there's not going to be too much difference between what's happening at your standard McDonald's and your standard Taco Bell. They're also going to have, you know, Uber Eats, in walk-ins, drive-through, sit down. Have McDonald's said, you know, what you can and can't do with the learnings you're getting from that initial program?
They have not. So there are no restrictions whatsoever on that at all. They were very open about that. I think they, clearly they've got a very dominant position generally in the QSR landscape, and predominantly in the US as well. So that topic did come up very briefly in the early discussion stages, but they were very happy not to provide us with any restrictions on that basis. We're actually working with their technology consultancy, basically their in-house. Well, it's an outsourced, but generally their trusted software consultant that is the source of the opportunity for us. A company called Helverson Group, and Helverson Group has similar contractual relationships with, the top 20 QSR brands outside of McDonald's. So the intention is and was always to trial this, get it working and effective. McDonald's gets, a first crack at this, so to speak, and the ability to roll this out before anybody else. Which is what they're doing at the moment. But we have the ability to now take this out to anybody and any one of their competitors. They've actually been quite collaborative on that basis, in fact, and we get a lot of learnings supplied to us from McDonald's around the QSR landscape in general. So in short, no restrictions at all.
Okay. And is there potential crossover to the kind of broader retail, you talk about like Westfield and GPT, taking the learnings there and pushing that to a whole kind of center vibe in terms of, you've got quick service, you've got maybe fine dining, you've got takeaway food offerings, but looking at it holistically of like, how do we manage our kind of food offering within this center with the learnings from McDonald's? Do you think there's a possibility that it can be extended out past QSR to a more kind of whole food offering for somebody like a Westfield, and how they're managing Uber drivers arriving at the center, how they're managing people who are grabbing something from the office and going back to the office versus people who are sitting down as part of a kind of a longer stay at these centers?
Look, it's a good question, a specific use case. I think what I would say to that is there's no reason we couldn't create some sort of benchmarking report around the behaviors of people in the food in the restaurants and the QSR chains in shopping centers or airports for that matter. So no reason we couldn't do that. It's not something that's come up at this stage, but we own the learning, so no reason we couldn't fashion that into something that became a benchmark that Westfield and other REITs would be interested in.
Okay. And then finally, I know you mentioned the 3 specific verticals from an industry perspective that you're highly focused on. Is there any international markets that you're really trying to penetrate into in 2023, or is it still very much US, Australia, to a certain extent UK and Europe focused, or is there another market you'd really like to broaden the Skyfii presence in from a geographic point of view?
So I guess specifically, I'd really like to see the US become a third of our total operating revenues. That's a goal for me this year, and obviously continue to take more of the lion's share over time. It's still our single largest market opportunity, and we've really started to see momentum in the last 18 months. And this year, I think we will get to it being a at least a third of our revenue contribution, which is great. Outside of those three core regions which you mentioned, that is really where our resources are deployed at the moment. The only other area that is of significant interest, we've got some penetration in, but not enough, and we want to really grow, would be the Middle East, specifically the Saudi area. There's just a lot of investment going into infrastructure, and they're investing a lot in cutting edge technologies across the board, not just in airports, but across city projects in Saudi, and we see that being an area that we definitely want to try to penetrate as well.
Okay. Wayne, I know it's pretty much end of the day there for you, so I'm going to let you go. We're just up on time here now. Thank you very much for coming back and giving us an update on all things Skyfii.
Excellent. Thank you, Mark. Thanks, everybody.
Thank you. And I do know we're going to flip now from West Coast USA to East Coast USA. Oleg Vornik from Droneshield is with us, and I'm actually going to drive the slides for Oleg. I'm just going to get the presentation up here now. Sorry, where's it gone? Here we go. Oleg, I think you're joining us from Boston, if I'm correct.
Thereabouts. Thanks for hosting me, Mark. We released our quarterly December results and also our annual revenue and cash receipts today, this morning, as we operate on December year end. So this presentation covers our record results and some of the surrounding recent news. Slide, please.
Okay.
We have released another set of record results, continuing to post on each year of our existence being a record year, with a 60% revenue increase to about $16.9 million for the December 22 year end, and cash receipts similar at $15.6 million. Two all-time record results or record sales were received in December and January, two different government customers. That continued our trajectory over the last 7 years. So for those on the call who are not familiar with our story, we as Droneshield detect and defeat nefarious drones when they're used in a situation like we supply to Ukraine today, where Ukrainians use our equipment to detect and take down Russian drones, which are used to drop charges, scout out areas, and direct artillery strikes. We supply to prisons where criminals use drones to deliver contraband like cell phones, weapons, escape kits, and so on, to airports where we're deployed at several key airports already and rapidly expanding, where it's really dangerous for a drone to fly around and potentially gets ingested into an engine of a plane and blow out the engine, because unlike a bird strike, if you got an item with metal or metal parts and batteries like drones do, that's a really big risk to the engine, plus a bunch of other applications like counterterrorism and so on. So we progressed from really starting the market when we began 7 years ago to figuring out the product lineup that I'll talk about briefly, to demos, smaller sales, regular smaller sales, regular million plus sales, to now evolving to two back-to-back 10 million plus orders. And the next step is to go into 20, 30, $50 million record orders. And we think we are essentially there at this point in terms of expecting some of those large contracts to land, especially as the world is becoming a more unsettled place and people are realizing that conflicts are a thing. Drones are the new generation weapons used in conflicts, and defense and security budgets are increasing at record pace around the world. The third point on that slide, so a couple months ago, we were recommended as part of a consortium led by US defense prime called SAIC, which is a Fortune 500 company, for a rollout across US Department of Defense bases nationwide, and we expect that to commence this year. We are the critical part of the system. The heart of it is, if you like, being radio frequency based sensing, which is the core detection sensor, and also smart jamming as the core part of the defeat for the consortium. Going through the highlights, we've done the first US airport deployment a few months ago, in addition to a couple other airports we deployed at, and that is serving as our land and expand strategy. There are hundreds of large airports across the US, many thousands around the world, and virtually none of them have counter-drone system today. So we think we're really well placed for mass deployments through airports globally. Numerous 1 million plus deployments across various customers. So we are in over 100 countries around the world. US is by far our largest focus, as the budgets and the opportunity are the greatest there than anywhere else. But also we of course focus on Australia. That's our home market. And also we've been selling to a bunch of European and other customers around the world. $3.7 million investment from Apparis. So we actually teammates with Apparis in the SAIC consortium that I mentioned just before. They are a US defense technology unicorn, multi-billion-dollar valuation, doing software-defined directed energy systems. To put it in plain words, it's basically a panel that sends microwave signals that destroys any circuitry or electrics in any devices that come certain distance in front of it. In the counter-drone industry, that's called hard defeat, meaning you basically destroying the drone beyond repair. And same for swarms. You can do single drone or swarms. And that complements what we do really well, because we do detection and soft defeat, meaning through our jamming, single drone or swarm, you can land it down without damage. But then if the customer wishes, they can use Apparis's technology to do the hard defeat. So as part of our increasing collaboration, Apparis has invested $3.7 million in us in late November last year, and we're continuing working with them. In the interest of time, let's skip to the next slide, please, Mark. And next. Thank you. To those new to our story, why are small drones an issue? So firstly, payload delivery. In the military setting, that could be a grenade. In the terrorist setting, that can be a chemical or biological substance. In a prison setting, that can be delivery of cell phones, cigarettes, escape kits. Intelligence gathering, so again, in the war setting, that could be directing artillery attacks or troop attacks. In the corporate setting, that could be commercial spying. Like, for example, we've been seeing drones used on racetracks for car companies to understand what their competitors are up to, surveillance, and so on. Nuisance, so airports and critical infrastructure are probably the largest sufferers of that, and it's very hard for an airport or a power station that doesn't have a dedicated counter-drone system to actually do anything about drones as is. Cyber and ransom are probably least understood part of nefarious applications of drones, where you can land a drone on the roof of a data center or maybe a ship and use proximity to hack into the controls of the facility and create damage, ask for ransom, cause terrorist attack. Slide, please. There are three parts to the Droneshield business. Counter-drone detection and defeat of small drones is the core of what we do, and that will continue. Today, we have over a $200 million pipeline in our core business. And the two adjacent areas are artificial intelligence and electronic warfare, where we have a 2-year, $3.8 million contract with the Australian Department of Defense. And the way to think about it is, it's like looking for needles in haystacks that you've never seen before. So as we developed our technology to detect never seen before drones, the Australian DOD came to us and said, well, what about looking for other targets that never been seen before? And this is that work in the radio frequency spectrum, electronic warfare. And we're expecting much larger contracts to come that way, and also take that work, that knowledge, and potentially apply it to the US market, which is much bigger budgets. The last box, which is AI and computer vision and sensor fusion. So we just finished initial 1-year $800,000 contract with the Australian DoD. That pushes our AI in computer vision, or being able to see drones with cameras, and also fusing output from different sensors, being radio frequency sensors, radars, cameras, acoustics, in a much smarter way. So you get paid for doing the work, but then you get to sell the finished product to end customers around the world as well. And we're expecting a follow-up contract on that with Australian DoD as well. Slide, please. 3 steps to counter drone operation. You need to detect first. Often people focus on defeat, but a small drone with its lights off, really quiet, is usually very difficult to detect until it's often too late. We provide a very far range detection and tracking ability of both the drones and the pilots. The next step is assessment. Rule of thumb is bigger drone equals bigger problem. We're able to give you that eyes on target, like you see in the bottom right insert on our C2, actually tracking the drone in real time. And then the response, which can vary from using our jammers to take down the drone or swarm of drones, or potentially if you're a prison, we can tell you where the pilot is, so you can send security and apprehend the pilot. You can track where the drone is in real time and apprehend the inmate who picks up the package, and that way get to the root of the issue, as opposed to just taking the drone down and then the person can come back tomorrow with a different drone. Slide, please. Some of the highlights. So we see ourselves as an AI platform. If you asked me 3 years ago, I would tell you Droneshield is a hardware business. Today, we still do hardware with SaaS, and we'll go to the product slide in a second. But fundamentally, the real sophistication of Droneshield is software updates that sit on the hardware, proprietary hardware that we sell. SaaS is a relatively small part of our total revenue, and so that'll be under 10%, but in the next 5 years, we expect it to be inching closer to half of the total revenues as the number of hardware devices in the field continues to increase, and then the SaaS element becomes larger. Leverage to the global defense and security sector. So as I mentioned, the world is becoming a more uncertain place. The budgets are rising for counter-drone, for defense, and also for electronic warfare. And we are very much beneficiary of that, as unfortunate as I guess the current global situation is. We're also the only pure play counter-drone business which is publicly listed anywhere in the world. So provide exposure to that sector. Sales pipeline. So we have a qualified sales pipeline with about 90 different projects worth about $200 million. And the idea is, we often say it's P-go and P-win. P-win meaning if the project goes ahead as a Droneshield or its competitors, and we believe we're really well positioned competitively. There is a slide on competitors at the back of this pack, but fundamentally we find we virtually never lose a tender. However, the issue comes in the P-go, or probability of winning the tender, when the tender may or may not even go ahead, meaning with government processes, things often get delayed, changed, cancelled. And the way we mitigate it is we say, well, with so many projects on the go, even if some of them get done slower or not at all than we expect, then it doesn't matter, because there'll be plenty of other projects which will come and will continue delivering record results. 4, we have very much a blue chip customer base, like Australian and the US Departments of Defense. The reason it's important is not just because it gives us street cred for selling to others, but also these are not customers who are in the business of issuing a single million or a $10 million order. They have very significant requirements. So what we're seeing now with large continuous orders, and by the way, all of our business substantially been repeat orders since the beginning, we're seeing these customers progress with us from a few 100,000 to $1 million plus to now 10 million plus orders. And they'll continue ordering increasing amounts of our products as they get more comfortable with us. And it's much easier to make a repeat sale than hunt for new customers for us as well. Number 5, there's a separate slide on the revenue, but 60% jump from the previous year, which was already a record year. And we really believe that 23 is an inflection year for us, as counter-drone industry itself really comes into mainstream now. And Ukraine, as unfortunate as the conflict is, really highlights the importance of drones on battlefield. But even aside from Ukraine, all the other applications like prisons, airports, and militaries around the world are driving the counter drone requirement. And also, we've been in the market for long enough that people are comfortable with us. They understand the product line, what the products do. All the hard work is essentially done, and now it's just about ringing in bigger orders. Point 6 already covered. Slide, please, Mark. I'll skip through the wordy slide, but this is all from the presentation we released this morning, so you can read it at your leisure. Slide, please. So on the revenue growth, we posted another record year for 22 for revenues and cash receipts. And as I mentioned for the bottom right slide, most of our cash receipts being through repeat customers, which you see in the orange as opposed to gray bar. Slide. A little bit about Epirus. I think I covered most of it. So you see a picture on the General Dynamics Striker vehicle there, and now they make smaller versions of these panels as well, complementary to our detection and soft defeat, and we expect to do much more business with them as time goes. Slide. Geopolitical environment, so record budgets, both US and European, but also even Australian Department of Defense undergoing defense strategic review and focusing on that asymmetric warfare and deterrence from China, but also how do we have homegrown technology. So being an Australian company is very important to provide the kind of asymmetric capability and also gray zone warfare, which is what drones are, right? So kind of war without looking like war, and using drones is very much part of that, and counter drone is fitting within that. Slide, please. And slide. I think we'll skip through a bunch of these. So 10 billion addressable market. As I mentioned before, it's not just military, but prisons, law enforcement, intelligence agencies, airports, energy production facilities, stadiums. The market will continue to expand. Today, probably about 60% of our total revenues come from military customers, and about maybe 17-20% from intelligence, so substantially military and intelligence community. But I expect other customers to adopt, like any new technology, start with military that leads that adoption cycle and expand to civilian customers. Slide, please. And slide. Thank you. So that's a product lineup. There are 3 lines to our revenue, being sale of hardware, which is the biggest part of what we do. Every piece of hardware that we sell, with exception of drone guns, comes with optional but recommended software subscription, and the customers get initial 1 year with the purchase, and then they're incentivized to purchase additional software updates, which we issue on a quarterly basis, because it's a bit like antivirus hardware, antivirus software. You have new drones come out all the time, and if you don't do your software updates, the product will eventually become less useful. So 3 families of products, being the dismounted or handheld products, the drone guns for defeat, and RF Patrol for drone detection. Quite small products. RF Patrol, just to give you a sense, is the size of a radio, about 1 kilo package. Drone guns are, the pistol is about 2 kilos, the rifle is about 7 kilos. So again, very small by the industry standards. Drone Sentry X on vehicle product, that's a radio frequency based detection and defeat, either individual drones or swarms, and can also go on rooftops, on ships, quite a universal little product. And Drone Sentry is on mast, multi-sensor detection and defeat combined system. And to give you a sense for pricing, we're talking tens of thousands of dollars for the drone gun, hundreds of thousands for Drone Sentry X, and well into hundreds of thousands of dollars, crossing over $1 million into Drone Sentry. Now focus on software for a second, and software is frankly my favorite bit because the scalability and the margins are great on that. So the R&D contracts, which is the 3rd leg of our revenues, being hardware, SaaS, and the R&D contracts, the 3 legs of revenue, is a big part of what we do. And there are a lot of learnings we take from that into our counter drone world. And then RFAI is what we call our quarterly subscription on virtually every device you see except the drone guns. And then Drone Sentry fixed site system has what we call Drone Sentry C2 command and control system, and Drone Opt ID, which is our optical AI built into that. So it's essentially 3 different SaaS products plus the electronic warfare signal intelligence software piece. Slide, please. These are just different ways of detection of drones. I'll skip that. And probably can skip the next slide, the defeat. We're focusing on smart jamming and move on to competitors. So we've been in this market right from the beginning. We are the pioneer in the space, Australian-based global leader in the counter-drone sector. When we first began, there was virtually maybe one other company globally doing what we did. Now there are dozens of companies, but we continue to maintain our edge in several ways. One, a lot of our competitors tend to be either sensor makers, so they may make one individual product because it's easier and it's cheaper just to do one, or they are integrators, meaning they don't make their own products, but they stitch together third-party products using their own C2. So we are both a sensor maker and an integrator, which gives us more flexibility with how we pair with others, or ability to sell complete systems, whether it's body-worn, vehicle-based, or fixed site to any customer that we wish to sell. Also, over time, we build a pipeline in the defense industry. It takes years to develop those relationships, the pipeline, but customers are also very sticky for that reason. And you have that competitive advantage once you're in the door with the customer. And it's very difficult to replicate the whole model between the hardware, the software, position in the tenders, the reputation in the market. So we're really well entrenched. Slide, please. These are some of the competitors, mostly US based. We see different competitors across different tenders. As you can see, they all pursue different families of products, whether it's handhelds, vehicle, or fixed site. They tend to be, like I mentioned, either integrators like Anduril or individual sensor makers like some of the guys on the right. And by the way, integrators are not necessarily an enemy for us. Sometimes we cooperate with them because we are provider of individual sensors as well. So for us, revenue is revenue, whether we're leading with a customer or whether we're supplying to somebody else. Slide, please. And I think that largely brings it to the end. Last slide here. So where to from here? Continuing to grow the counter-drone capability, as we really, like I said, seeing a transformative year this year in jumping beyond those 10 million plus contracts into multiples of 10 million. Electronic warfare will continue to grow and taking SaaS from sub 10% that it is today to hopefully close to half of our total revenues over the next 5 years. So that concludes the presentation, and we can go into Q&A now. Thank you, Mark.
Thanks, Oleg. I'm just going to leave this slide up just while we're doing the Q&A. If anybody wants to note down the email address there if there's any follow-up questions. Just one on the airport deployment. Did that require, I'm just thinking of competitive advantage, does that require, Droneshield to get, FAA licensing or approval to actually use the Droneshield products to counteract drones around the airport, or can individual airports, whether they be in the US or elsewhere, bring you guys on board without having to check with the various airspace regulators?
The beautiful thing about our airport products is they are completely passive. They do not interfere with anything else. They are simply listening for that handshake between the drone and the controller, as opposed to emit like a radar would, and that you create interference with other systems and potentially flight controllers and whatnot. So for an airport, would usually lead with a radio frequency sensor like our RF1 fixed site or RF Patrol, even Drone Sentry X, in a passive mode, and then link it to cameras using our camera software, which is again completely passive. So that gives you really far range, much more than a radar would, which is important for airports because they are larger areas. it would not interfere with anything. So in the US, if you would be deploying a radar at airport, you would not only need FAA's approval, but you need FCC's approval as well. Federal Communication Commission, a bit like ACMA in Australia, regulates everything that emits. And because our sensors are completely passive in the detection mode, there'll be no need for those approvals. So that makes it really easy because airports don't have to go through the whole approval process.
Okay. And then in terms of, these, big contracts that have come online and you're expecting more, I'm just wondering, how do you ramp up the production of hardware and, kind of a capacity from a manufacturing supply side to, get these products out to customers, the various DoDs as quickly as possible. We still know that there's supply constraints, especially around chips and stuff, although it does seem to be easing from what some people are saying, but we're not fully back to normal supply chain logistics, especially around technology products post-COVID.
We are seeing supply chain starting to ease back. There are several stages that we are very mindful to make sure we don't hit capacity constraints on. So the first stage is starting from chips and other parts of supply chain, and we're making sure that we're buying enough so that it doesn't become an issue. And we have dedicated supply chain members on our staff that regularly talk to our suppliers. So you're not just talking to the supplier when it's time to place an order, but you regularly maintain dialogue to know what can be delivered in 30, 60, 90 days, more than 90 days, to make sure that for virtually just about any order, you can deliver it in about 90 days, which is, by the way, really rapid by industry standards. So componentry is first, and holding those long lead items. The second part is, once you get all these long lead items, both generic and custom made for Droneshield, delivered to our facilities. And by the way, we have 2 outsourced manufacturing facilities as well as our own facility in Sydney to, again, deal with the scale. You need to make sure that you can put it all together in a way that doesn't create bottlenecks. And again, it's a fairly well-designed process where you collate, you do quality assurance, anechoic chamber, and so on. Because the products are not $1,000 a piece, we're talking tens of thousands of dollars for the cheapest product. You don't need to make millions of products. And, we're talking a big batch for us would be 100 units of a particular product. And, that's worth well into millions. So assembly is the next bit. Deployment is the next bit after that. So you want to make sure that your deployment is scalable, that you understand. Some products like handhelds really don't need deployment. It's more about training. Some products like our fixed site system, you want to do site survey, make sure that things are going to go smoothly once you deploy, and the whole thing is just going to work as much out of the box as possible. So we are very mindful that our DevOps, our engineering side of things is related to deployment is slick. Training of users is important. So we are continuously working and reworking our training materials to make them as easy to understand as possible. And that's your essentially PDF kind of written brochures, videos, how we structure the lessons kind of over the video. For fixed site stuff, we often send engineers over for a couple of weeks, which includes installation and also training, but we also set things up to do as much of it remotely as possible, again, for scale. So in short, we're not taking this lightly. We certainly don't want to be hitting bottlenecks, but so far we've been fine, and we aim to continue to make sure we don't hit capacity constraints.
And then a final question, if I can just squeeze it in here. Obviously, the Ukraine-Russia situation has reignited or caused a big reassessment of military alliances. Who's aligned with who, and might be restarting all the alliances, or kind of cementing them that they were there, but maybe not as to the forefront as had been over the last 20 years or so, and the US's I guess quasi Cold War moves against China on the technology front, you know, really limiting the stuff that US companies can supply to China. Just those changing military alliances and the US's kind of stance on, you know, giving various technologies to China. How does that either affect you or benefit Droneshield as a kind of as an overall impact on the business?
The move against China has been a trend for a number of years now, but as you said, started to accelerate in the last year or two. We have been careful to make sure we're not dependent on China for our supply chain, which substantially comes between Australia, US, UK, and a couple other countries aligned with Australia and the US. Being an Australian company operating in the US is probably the next best thing to being a US company. But in fact, in my opinion, it's better because for some things like export controls, the US system is incredibly complex, and it needs to be. It's not a criticism. In Australia, it's much more, let's say, streamlined and efficient. So, for example, one issue that's burdening some of our US competitors is you try to get an ITAR approval out for a country, any friendly country, might take you 6 months, while we're seeing approvals within a month for most situations. So being an Australian company selling in the US and being part of that AUKUS, part of Five Eyes, is really valuable. We obviously share a lot of cultural similarities. We never sold to China or Russia or any of similar countries. It's not our market. US is by far our largest focus in selling to other countries aligned with Australia and the US.
Oleg, sorry, my Wi-Fi just dropped out there for a minute or so. Sorry, I missed the end of your answer there, but I think we're just up on time as it is. So I think we'll leave it there for this morning. Thanks very much for dialing in from the road. I know you're over in the US traveling, so it was great to hear the update firsthand.